Testing 1, 2, 3. Testing 1, 2, 3. Testing, testing. It should be perfect. Thanks, Ruth. All right, great. So I just thought it'd be interesting to point out why do traders look back and say, whenever I'm right, I'm always in one, and whenever I'm wrong, it seems I'm always got too many on. And one reason is lack of discipline in following the guidelines to keeping proper position size. You know, you find this when people, I always find it interesting when we have like a slew of winners and there's one losers. And then I get emails and question after question after question. What are you going to do about this one trade? And it's obviously when I get down to the nuts and bolts of it, and it seems it's like the individual when student body left and just said they went all in. And you know, every time I make a recommendation, I say we're going to put on a small position, we're going to put a portion of position on, and that's why we do spread around trades, not only just specific trades, but also different markets. So if you have a problem with being or finding yourself in too many losers and too heavy, and so if your winners are few and you have too many of the winners with small positions on and your losers are bigger, guess what? It's going to be a problem, and you've got to have the discipline in following guidelines to keeping proper position size. What that is the greed factor button gets pushed in your subconscious mind typically, and you say, and you feel good about a trade. Anytime I feel really good about a trade that it can't lose, this is the greatest, I got to get this on, those are the losers typically. When I feel, and I'm being honest with everybody in the room here, when I feel over 35 years, the trades that scare me the most, those are the winners. And those are the ones that you typically have the least position on. So you can't be picky and choosy. Many of you discovered last week I was picky and choosy on a day trade. Remember this? We had a high closed doji, and while it was on a 15-minute chart, I'll never forget this, and neither should you. We had a 15-minute high closed doji on a bearish day, PPS sell signal. I think it was this day right here, and if I'm not mistaken, it was Wednesday. It was right after Tuesday turnaround, and I said, guys, I'm not buying this 15-minute. First off, it was, I think, going into the lunch hour, number one. And number two, I said it's a PPS sell signal. It's a bearish person's pivot day. And even though there's a high closed doji on the 15-minute, the system went long, which I announced to you, but the risk factor on a one lot was 6 handles. That's 30 ticks. Now, every trader, they all talk about how great trading is, and everyone's making money in the market. You know that, I know that. I mean, every email I get is everyone's making money, and there are great signals, and I have great signals, and you've got great signals. But one thing that we've got to really sit down in the nuts and bolts about is what was the risk to take that profit? If you have great trades, what's your stop? You know, what is your risk factor when things don't go right? And you got to remember, even if a system is 58% accurate, which means you're going to have maybe 5.5 trades out of 10 losers. You need bigger winners than the losers. This is how we examine setup signals, triggers, pattern recognition techniques, is based on what their relevance is between the risk and the reward. And if the rewards, even though it's a high probability trade, if the risk is too great, believe me, there's another trade another day. So at the end of the week, we need to uncover what it is about proper position sizing, and diversification is the key to success, they say. So with that said, I thought that this would be great. The good news for those that have a problem in keeping proper position size is that we have a solution to this. It is teachable, and all of you that are in the TTU program can go back and review this. It's a lifetime membership. It was a one-time fee, and you guys can keep back and back and back and review this section on position sizing, and I strongly recommend it. All right? Now, the reason I kind of went on this tangent is because while I was in New York, you know, I had been approached by a few people and at the options conference in New York City, and said, you know, I've had this problem, I've got this going on, what do you think? People were more interested in asking me for my market direction opinions. And almost the majority of the questions that I got were people that were on the wrong side of a market. And I simply asked, if you're asking me about a trade, then you obviously have too many positions on. And of course, people chuckle, yeah, it's true. Because I think I don't want anyone to do that. It's not the greatest trade that's going to retire you. It's the progression of trades that gets you ahead of the game. And I hope everyone understands that. So with that said, last week, all the major stock indexes, as you can see, every one of them closed lower on the week. The bottom charts here are the ES, the Qs, the Russell, the New York Stock Exchange Composite Index, and the Dow. So we take a look at this, and every stock indice had a decline, and some more significant than others, and we'll talk about that in a minute. Okay, biotech, we saw some stocks give it up, like Celgene, the stellar ascent, the parabolic direction up seems to have stalled a bit, so to speak. And semiconductors and computer hardware, which start their seasonal weakness like about, I don't know, this week, today, and towards the end of the week. The funny thing is, we do have the CFTC commitment to traders data still reveals small specs are long, and commercials and professionals are still on the short side. So I would like to first off take a look at this one by one. And we're going to go right over here to Tools, Commitment to Traders Data, Get Report. Everyone knows how to do this. If you don't have the indicator on Genesis, we want to look for Chicago Mercantile Exchange. I like short form futures and options combined because it tells me if someone has an option position on, they may have a synthetic directional trade on and using options, and that volume and that trade is not going to show up in futures only. And then if we want to gauge what the small speculator is doing, we don't want to look at the big S&P, we want to look at the little S&P. By the way, this is a very large open interest, 3,935,333. We get close to that 4 million, 4.5 million. That was the open interest we had in the March of 2009 low. And I can show that to you in a minute. The funny thing is, look what happened as of the week ending 9/9. That's Tuesday. So from last Tuesday, the market, this data was released on Friday. We're still at about 11.2%, close to 12% for E-minis exclusively. Every different market has a different parameter setting. It's not a general number. In other words, bonds is not 12%, beans, soybeans aren't 12%, gold's not 12%. Every market has a different makeup. In my research and analysis for E-mini S&Ps exclusively, I hope you understand, exclusively near 12% is the danger sign of a overloaded boat, so to speak. Interesting, last week they got out of 4,600 short positions and they added 16,000 long positions, the small specs. Take a look at the hedge funds. Now, they were short the market. They got out of 15,000 shorts and added 8,000 longs. So they're less short, but they're still net short. And the commercials, look what they did. They went long 131,000. They added 176 for a net large short position. So the commercials are net short, the hedge funds are net short, and the small specs are net long. That to me is still a major warning sign for this market. All right? So I just wanted to show that to you as the information was released on Friday at 2:30 Central Time. So that's what we said last week, and I just wanted to say, hey, watch for a mid-month peak or turnaround in the NASDAQ 100 since we have two sectors which could weigh in on the NASDAQ. I still said that I think we could see a potential 1 to 3% appreciation in the spiders in the near term, but I'm thinking it's start implementing hedging strategies, not covered calls. They won't protect you in a downside market of individual stocks. You want to start looking at collar strategies if you have specific big profits built into a trade that you don't want to get out of. Selling out of the little slightly out of the money call option, use that money to help finance a put. That is a collar, and that will get you a little protection better than just an outright, covered call strategy, which people, educators, tend to think that's the greatest thing since sliced bread. In a perfect world, they are. In a sideways market, they are, but I don't think that this is a sideways market condition, and neither do you. So I think we can also look to sell and tuck away some cash on these rallies by liquidating a portion of your mutual fund or 401k up here, and that's if your 401k or your mutual fund is even in the stock market. Just because you think you're in a mutual fund or a 401k that's in the market, the fund manager may have already put that fund in cash. So you have to look at your statements carefully, because they may have gotten out of the market and sitting on the sidelines, believe it or not. So while that's why stock market indices go up and performance of funds don't mirror the S&P 500, because they play the market themselves. So watch this 1988 basis, the September contract. If we get a daily close under that level, it might get ugly. Well, it got a little ugly in the S&Ps. We traveled down in the September contract about, into the upper 60s there overnight. Now we're right back up again. So anyway, from last week, I think it was important to restate this information, because people definitely forgot. And I mean, when I was in New York at the conference, I asked people, we had the greatest bull run from 78 to 2000, the greatest bull run, but we had corrections that were between 10 and 30% in 1981, 3 years later in 84, 3 years later the crash of 87, albeit only lasted a week or so or less than. 1990, yes, it was the invasion of Iraq. 94, 97 was the Asian contagion crisis, if you remember. 98 in October was a simple little long-term capital management. Not to mention the peak in 2000 to the bottom of 02 was only a 51% pullback, and then the 58% correction in 07 to the low in 09. And again, in 2011, which was not that many years ago, it just seems a few months back, right? We had a small 22% correction that got a little ugly. How did it happen? Who knows? We also had a fat finger correction in the market. We also had that May panic selling. So the list goes on and on of all the different corrections that can stop people out of their stock positions or scare people out of the market. And with that said, I think the longer the duration of the time that this market goes parabolic, the higher the probability is that a deeper correction will ensue eventually, and we will see and we are seeing a sector rotational correction, and it's evident by looking at our relative strength charts, and that's something we'll get into in another second or so if we have time. So this week we have the FOMC, we have quarterly option expiration. There's a lot of new people that don't understand that the September indexes go off the board on Thursday. The options expire. Last trade is Thursday's close, but that's not the settlement. The settlement is based on the special opening, and then they add the dividend factor in. So the opening on Friday really is why they consider Friday quadruple witching, when really it's kind of like Thursday's close, you know. So it's for people that are short premium in the September. Those are the ones that have to do something immediately. Now, we had rollover last week in the futures, and it was interesting that sometimes some software providers do it automatically on the close of Thursdays, and some did it on the close of Thursday, which was really bizarre. And we were telling you that we had rollover. And so when you look at your volume and your open interest, when you go through rollover, you don't have to really trade out of immediately from September to December. But starting today, you want to have all your platforms, all your chart analytics converted to December. Today, after Thursday, Friday, and the weekend, everything should be converted. You should be trading this week on the Friday, after Friday's close. You should be trading today on the December contracts, okay? If you're trading and day trading, E-mini, S&Ps, and all of the indicators. As far as the other indicators that we have, the McClellan oscillator, both daily and weekly, have crossed below their zero lines, suggest more selling pressure as possible, and we saw some follow through on the overnight action. I think over time it's going to be a tricky market. They seem to take it down in the overnight session, bid it up in the day session, and then take it back down in the overnight session, and that trend seems to be what we still have. We are at weekly, and there's the opening bell. We have weekly what we have is the weekly. Lost my train of thought. Weekly, I wanted to get into the weekly charts. Here we go. The weekly moving averages are kind of holding on the Qs. The weekly moving averages are kind of holding on the Russell, the IWM. Interestingly enough, we don't have a single weekly sell signal. And we are up against, and you know, this was hard for me to say back over a month ago that we would go up to quarterly pivot resistance, but yet in the Qs, here we are near quarterly pivot resistance. We have yet to make a weekly lower closing low, except for this week, and we had an extra week of sell-off. And if you note, that was the third week of July, that little correction that we saw. And even with last week's sell-off, we did not get a lower closing low. We did here in the S&Ps, so I would imagine unless we get a the upside target of resistance for this week in the S&Ps should be, based off the December, the midpoint of last week's range. So this is an engulfing pattern. We had a lower closing low. Two things come to my mind. With the Fed meeting, anything goes, number one. Number two, with quadruple witching, which is not going to be as important as the Fed's announcement and the Fed's wording of what they are going to do for quantitative easing. But if the market is going to respect a corrective time period in the market, then you don't want to see the midpoint of this market violated. Otherwise, we more than likely will form what's called that equal and opposite. The advanced decline on a weekly still maintain levels above every single index except for the Russell, maintain closes above my moving averages on the weekly basis. What this suggests is shorter term weakness in all the daily charts, so maybe in the next couple days, and that means chop and slop back and forth, two-sided trading. That's what that means to me. All right? So as far as specific trades are concerned, we have the euro currency, which, as I've mentioned last month, has seasonal strength mid-month. So it could be a little bit of short covering in that market. We also see in the commitment of traders data, and if I may take a look here, because it is interesting to note that this is the end of the quarter, and heavily controlled or heavily invested markets from hedge funds. They get paid on a quarterly basis. If you've had a trend, it's not 100%, but it's very accurate. If you have a trending market condition in a quarter that they're heavily in one-sided, so if the trend of the euro this quarter, which has been down, and they're heavily short, which as you can see, the hedge funds are heavily short, okay? 219,000 versus 59.6. They are heavily short this market in this quarter. If they want to get paid the profits on that short position, they need to buy back their short positions, close the trade out. They can always get right back in it, but they need to book a profit. If you note that they got out of 5,000 short positions last week in the euro as of Tuesday. That left Wednesday, Thursday, and Friday's data we don't know about, but we can assume they covered more. The small speculator, they got out of some longs finally, and they added short positions. So hedge funds are taking profits, small specs are getting short in the hole after a 3-month decline, for gosh sakes, or at least a 12-week 5% decline. Meanwhile, the commercials, they're adding long positions, net long an extra 1,000 or so contracts, but they're still a boatload long the market as a hedge. So the euro has susceptibility for upside moves this month. Interesting, we are against monthly support and seasonally strong, especially looking at a daily on-balance volume. So it is in your sheets there. We did close in the ES below 1988 in the September contract. It did project short-term weakness. Gold just traded below monthly support on pretty weak weekly on-balance volume indicator. Friday, I sent out a tweet. It may not have given you enough time to buy back the 126 calls on the October 124, 126 vertical call spread. So this is the one loser that we've had in the trading room. Bonds. TBT. We did the same thing with TBT. If you remember, I said in half your positions, buy back the 60 side of a 58.60 D's call spread. And then as the market rallied, I took profits on the long 58. So when the market went down, the short side we took in premium. When the market popped back up, took some profits, closed out half that position. Now I'm still just in the 58.60 call spreads, which are working for the bonds. We need to address the bond market through the next week or two as we conclude this quarter. Not just quadruple witching, but the quarter. All right. Crude oil has a daily bullish last conditional change on a close above 93.10. September's typically a weak month, but towards the end of the month, into October, we see prices can bottom and start to rally. Feeder cattle, I bring feeder cattle back up in the January because we had a PPS daily sell signal in a seasonally weak time. I would look to buy put options if we see a rally in the next couple days. Stocks to watch. Interesting. Lucadia, LUK, and the KBE, a lot of regional banks popped up on my radar screen this week. Maybe because the regional banks might get a boost or help from the Federal Reserve's actions, and that's why we saw a lot of weekly high close dojis. Bearish trades. I saw a lot of automotives 3 weeks ago. The automotive sector seemed to be, and parts 4 weeks ago actually, was very strong. And now I have a numerous of stocks in that space that are generating sell signals or have declined, and specifically AutoNations and Delphi Automotives generated weekly low close doji. Hess, I can understand why Hess is moving lower, is because of the influence of crude oil. And again, bearish, we had CMG, which popped on a weekly low close doji. So this would be a lot of the information this week is going to be, you know, we have today the Empire State Manufacturing Survey, industrial production, you know, which to me is not a no biggie. Producer price index, listen, there's no inflation according to the Fed, so they're not going to change that story from last month to this month. Excluding food and energy, they'll even say energy's lower. There's no wage cost inflation, obviously, so that is one that you know, is a no-brainer to me as well. Wednesday we have the Bank of England, that's the BOE. Their minutes of their last Fed meeting come out at 4:30 a.m. Wednesday's a big day because mainly we have the FOMC announcement. It'll come out at 2 p.m. of what they intend to do, and Janet Yellen press conference at 2:30. Then that leaves us with, after we get through with that, I would say the next big announcement would have to be housing starts. And housing starts could be a surprise to the upside in certain regions, but I think it's going to show, as we pointed out to you a month ago, that there seems to be more multi-dwelling, housing units like apartments being built rather than single-family homes. So housing starts could be a surprise there, but I don't think it's going to be extremely positive. That concludes pretty much what we do for this week. And of course, for the earnings, you've got a couple. Adobe might bring some interest, of course, for any type of surprise there. We have FedEx, FDX comes out Wednesday. General Mills, Lennar, which interesting, is a home builder. So Wednesday's Lennar with Thursday's housing start could affect the ITB, which ITB is the home builders ETF, including Pulte, Toll Brothers, Lennar, and D.H. Horton. Next to that, we have probably Tibco Software, and again, Oracle and Red Hat. So Thursday after the close is probably one of the more interesting of the whole day. ConAgra is before the market opens. So those are the ones. Rite Aid is another one. So we do have a few stocks that we could look at. Apogee, I forgot the name, what they do, but you know, that's all right. We can look at that. We got plenty of time between now and tomorrow after the market's closed to take a look at those individual stocks. So if you take a look at earnings announcements this week and take a look at individual stocks and apply what we teach here, looking at the stocks on both daily, weekly, fundamental basis, I think we might have some trades set up for this week. But I think that if anything, on rallies coming back, CMG, we've been for the last, well, how many weeks now talking about CMG and Priceline being weak, and we've had some trades there that have made us some money. So again, when it popped up this week as a weekly sell signal, I was kind of surprised there. So with that said, we're still making lower highs, lower lows in the S&Ps. The S&Ps, even with that weakness and that sell-off, we did not get a new lower low reading on a daily basis, and nor did we get a lower low reading on the on-balance volume. So the S&Ps actually, you know, this we might see a muted downside move. The NASDAQ, though, the Qs is a different beast altogether, and I think we've already beat that horse to death. You guys should have some type of positioning in there, or we've been talking about the IBB. I've been bringing that to your attention for a while. As far as the Russell's concerned, interesting aspect, we're at monthly pivot support. The month ends in 2 weeks, and again, the advanced decline did not make newer lows. So I found it interesting that we did see the weakness in the Qs. We did see weakness, which is understandable, in the NYSE. Why is the NYSE weakness as relative to the advanced decline, as it relates to the advanced decline? Why does it not surprise me? Because a majority of the stocks are what? Interest rate sensitive and contains bond funds, and bonds got smacked in the face. But the sell-off, as you can see, was on weak volume. The Dow Jones Industrial Average, this is the one that has both components, a lower AD line on stronger downside volume. So this is the one, the Dow and the NASDAQ, we want to watch for maybe that influence of weakness. And where would it come from? Mainly the XCI and biotech. All right, so those are the focuses that we need to look at. It seems that what is contained in the Dow is blue chip stocks that are high dividend yield stocks. So people, they're not selling off aggressively the Russell, which this is the time of year that we tend to see the January effect, even though it's not January. But typically we see outperformance in the Russell, the small cap growth stock, kind of tends to outperform sometimes the large cap stock. So maybe that's what's happening here, as we see more value in the growth stocks with the Russell from a seasonal perspective than we do the blue chips that may be more institutional type portfolio management information rather than, you know, retail traders information. But I think from a spread perspective, you know, selling the Dow and buying the Russell somehow might be an interesting trade there. Next, I just wanted to share with you, and I know we started a little late and this is getting a little bit longer than we normally do past the open outcry, but on Monday's planning and scanning, I wanted to give you the full picture here. So just so that you could see this for yourself, this is the zero line. This is a daily McClellan oscillator. You know, funny thing is, we crossed below the zero line, but look where we're reading, 175. Now, what I find interesting is the market price hasn't gone down, right? It really didn't go down. And here we are already near an area on the daily chart with a few exceptions. You know, back here in July, we got down a little lower than 175. Here we are in April, we got near 175. Here we are in January, February for that sell-off. The list goes on and on and on, as you can see. This is near an area that the market actually gets oversold. So there's, again, conflicting information. I think what this points out to us is simply this: sector rotational correction. And I think it's the NASDAQ that might get more of the weakness in the marketplace due to the weighting of the seasonal aspect of the IBB, as well as the internet, as well as semiconductors. So let's take one quick look here, and we're going to go back since the beginning of the year. All right, so here we are. The semiconductors is this purple SOX. The semiconductor almost made what looks like to be a potential double top in the market, almost exactly, by the way. So the semiconductors And if people wanted to take a little bit of profit off the table, it would make sense to me. Next, we wanted to be taking a look at the, which I got rid of, unfortunately, and I'll put it back, so bear with me a second. Someone asked me to take a look at how these sectors compare to the spiders, which is the black line. The S&P year-to-date, as you can see, up nearly 17% for the spiders in this period here. This is a percentage change since January of 2014. Let me change this to IBB, which is the NASDAQ biotech sector, okay? Now, look at this. This is amazing. The two lone wolves of outperforming sectors happens to be IBB. Let me edit this one more time so we make sure it's correct. And we're going to go, let's go medium thin. There it is. All right, so you can follow it. So if you note, the IBB was up 23%. It's already dropped. It was at approximately 23% year-to-date gain. Now it's only 18.5%. So we've dropped 4.5% in that sector alone. So we are seeing a correction already underway, and so are we with the semis. What that would suggest to us that I'm not sure how much we're going to decline, but I know that at the very least we probably aren't going to make a major upside in the next 30 days or 2 weeks for that matter. So wouldn't it behoove us to maybe look at some credit call spreads in individual stocks within that sector or this sector in of itself? The two most underperforming sectors year to date, home builders is ITB, and you know, if the Fed does something that says, hey, maybe we need to do something about interest rates here, you better get off your horse if you're going to get a loan, or maybe they can ask Congress to lax some of the regulatory requirements that's needed to get a home. People just aren't qualifying for home loans. Maybe they had a short sale, and a short sale in their past would have hurt their credit, and they go down from, like, you know, an 800 to a 650, where people have had perfect credit. My brother's in the mortgage business, and he said in Denver, this is what's very you know, what's been happening is people had these second homes in the mountains and da-da-da-da-da, and, you know, people had their condos, and they, you know, things got tough, and then they had to sell, and they couldn't sell, and second homes, and all of a sudden credit, and people want to move, you change a job. Guess what happens? You might sell your house, but then you move, and you can't get into the new house. And so what do? Go rent an apartment or a townhouse for a while. This seems to be more of a bigger problem, and maybe why the ITB we're not seeing home builders perform. But the regional banks is this KBE. That's the regional banks. Can you imagine? They're only up 0.5% for the year. Next to that is the XRT. It's only up 1.43% for the year. So to me, I'm looking at the things that make the economy move are housing, consumer spending, and banks, which need to make money by loaning to people, and those three areas seem to be a problem. So with that said, we can get a lot out of this. If everyone's buying biotech and they think this is great after a 3-year run, I think it's all, you know, it's just due for a pause, and that's been our message here with you guys for a while. So with that said, that concludes this morning's planning and scanning, and I hope, don't forget, there was considerable information right here in this section of your weekly observation. You just need to know what these terms and what things mean, and most of you do know, especially what the knob spread is and what the last conditional change LCC means and what person's pivot support. So with that said, I want to thank everybody, and I hope that at least you got a better understanding of where the support or where the strength and weaknesses of the markets might come from and what sectors we want to be looking at as far as trading opportunities.